Hello, everybody. My name is David Warren, chairman of Bridgeford Trust Company, one of the co-founders. Very happy to be here with you today. We have a tremendous program put together by some extremely talented professionals from around the country. And it's part of the Trust and Estates virtual forum called Keeping Up with New Developments. And today's title is Primer on Working with High Net Worth Family and Family Offices. And again, we're thrilled to be a sponsor. The purpose today is to be somewhat cursory and high level in discussion, but we certainly encourage questions and online and offline for sure. I mentioned that I am one of the founders of Bridgeford Trust Company. We are a South Dakota-based trust company. Fell in love with the power of modern trust law, asset protection, and all of the things we can do with modern trust law, which really lends itself so well to this conversation today. We work very closely with family offices from around the country and across the world, providing a trust solution for their clients, and we love the space, which is why we're so happy to be part of this presentation. A couple of housekeeping items as we get started, and before I introduce our talented speakers. To improve your viewing and listening experience, you can move your webcast windows around by dragging on the title bar or resize them by clicking on their lower right corner. At the bottom of your screen, you'll find multiple application widgets. Clicking on those icons allow you to open and close widgets on your screen and will not remove you from the webinar. A copy of today's slide presentation is available for download at the resource list widget. Also located in the resource list widgets are the instructions for continuing education credits. And on that note, this of course is approved for CLE for 1 hour, CE credits rather. And throughout the broadcast, I will announce a code, a secret code that only I know, that will enable you to get your credits. And I'll be very clear. And if you miss it, certainly send us a question and we'll get it to you. So again, we're very excited about the presentation, which is going to be recorded. And with that, I'll get into a quick introduction of the speakers, who I indicated are extremely talented and people that I have known and heard of throughout the industry. Of course, Kim Kamen is Principal and Chief Wealth Strategist at Gresham Partners, LLC. It's an independent family office, and they represent and work with over 120 families from across the nation. And Kim's an attorney by training and an extremely talented and great presenter. Hugh is also very talented, retired vice chairman from Northern Trust Company, also an attorney by training, and does some consulting practice on the side. Very prolific writer and presenter himself, and will add a lot of value to the conversation. An old friend, Domingo, I've known for some years now. We met at Heckerling, which hopefully will be live again someday. He's with, of course, Perkins Cole, one of the largest law firms in the nation. They continue to be on the leading edge of all kinds of thought leadership, including the recent CTA concern that is sort of dominating our industry at the moment. So, the idea of this presentation, as we said, is to be somewhat cursory and high level, but to sort of set the stage. We kind of wanted to set out some general definitions of what we're talking about. High net worth, of course, generally is around 1 million. Very high net worth, 5 million plus. And ultra high net worth, $30 million plus. And the reason why we make this distinction quickly at the beginning is because each of these areas kind of have specific issues or maybe aspects of their planning that's more germane to each of the demographic. And our speakers will get more into that as we continue. This advisory board committee this is an advisory board committee who handles the content, particularly for ultra high net worth individuals. And the focus today and for the committee overall is succession planning, governance, family dynamics, philanthropy, regulatory climate, all things that are wildly important to the large families that we all serve and the families we serve at Bridgeford. So we're excited about the presentation. We're excited to get started. And a general overview is what we're going to cover is, of course, family offices with some definitions and how they work. Private trust companies, something that we're excited about at Bridgeford, continues to be a hot topic around the world, particularly for families coming into the United States. Regulatory concerns for family offices, investment issues, the IRS Wealth Squad, which is a fun thing to talk about, and other trends we're seeing in the marketplace. So again, Bridgeford is thrilled to be a sponsor and to be part of this panel, and we'll get started. Hugh.
David, thanks very much, and good morning to everyone. We're grateful that you've joined us for today's presentation. We thought we ought to begin by defining what we're talking about. And let's look at a couple of definitions that are out there. The first one at the top of this slide would be the broadest, a group of advisors who are serving a family. The second refers to a professional organization owned by a family whose affairs it manages. And we can thank the Securities and Exchange Commission for the third definition, which refers to an entity set up by a family to manage its wealth. The breadth of these definitions may be one of the reasons that no one really knows how many of these exist, either in the United States or in the world. But of course, families' need for discretion and confidentiality, protecting the identity of their family office, is another. Estimates of the number vary quite widely. SFO database estimates that there are about 4,000 globally. Ernst & Young is perhaps a little more generous. They think there are 10,000 globally. But the Family Office Exchange, based in the United States, has made some interesting estimates based upon their number of individuals in the United States who have at least $100 million. And extrapolating that number, they estimate that there are 10,489 family offices in the United States. Well, irrespective of the number, family offices rarely spring up fully formed out of nothing. Their structures and services evolve as the complexity of the family's wealth increases, and the family's needs increase as well, along with the stages of a family's wealth. For first and second generation wealth centered around an operating business, family office functions are often filled by a company employee whose expense is absorbed within the company's financial statements. Those families may at some point migrate to what we call an alumni approach, where an employee or an advisor is hired to serve a family independently and usually exclusively. That advisor often relies upon and augments an existing network of advisors to meet family needs, forming an advisory group sometimes referred to as a virtual family office. But at some point, for some families, because of changes in family leadership or succession planning and retirement or increasing wealth complexity, families consider more formal structures, either by affiliating with a multifamily office or forming their own dedicated single family office. Families considering that will need your help to consider some basic questions. The first seems so simple, defining who is family. How will the family define which members will be served by the office? Certainly lineal descendants, perhaps collateral relatives, but what about key employees and spouses or even former spouses? Second, which services will the family office provide to those individuals as a group? And third, what does that basket of services require vis-a-vis staffing and expertise? And then how will the family office be staffed? It's prudent, we think, for families to connect with other peer groups to see what families are doing and evaluate what's worked and what hasn't for families who have traveled that path before. And last, it's important to think about the dynamics of the deliberation and the decision-making around these critical fundamental questions. There's a pretty strong correlation between transparency and inclusion in terms of buy-in for the family office. Here's a menu of services for families to consider. Most families begin with custody and asset management, which form, in a sense, a kind of balance sheet foundation for their shared interests in marketable or alternative securities, direct investments, and perhaps real estate. This facilitates accounting, reporting, and even performance measurement, and certainly provides economies of scale for the way in which the family's collective assets will be managed. Tax reporting naturally flows out of this, but tax planning and tax compliance may also be corollaries, but will require staffing with the requisite expertise. There's a wide range of services on this slide, which I think are self-explanatory, but let's look at the top right of this slide where we focus for a moment on risk management. Wealthy families have traditionally focused on property and casualty insurance for all of their assets, including unique things like yachts and wine and art collections. But increasingly, they focus on digital security, ensuring that their systems, their data, their assets are secured. And also ensuring that family members understand that the way in which they use social media may place some of those things at risk. Physical security relating to the risk of kidnapping or the need for medical evaluation is another area. And then last, families that have important reputational issues will want to have a policy on who represents the family and speaks for it and can disclose certain things, and how will that reputation be recovered in the event that there is damage through an event. But Kim and Domingo, I'd be curious to hear about what you're seeing with your clients around these risk management issues.
Domingo, you want to go ahead?
Sure, I'll go first. The risk management issues that we have seen have been really focused on cyber threats. There has been no shortage of concern with respect to security coverage, and I think certainly a good portion, if not getting to a majority of our families, have experienced some type of phishing, cyber threat, or even malware that has occurred. That has caused great concern, and even I know financial institutions have been hit with this, and then every family office has been affected by it, which raises even more concern. Recently, we saw another incident where a ransomware was actually paid, and the demand for the payment was in crypto. And while in the past people thought they were doing that because of the anonymity, I think there was some hope that after something like a 5-year sting process, the FBI has actually confiscated assets of somebody who had been doing that kind of activity for a long period of time. So risk security is definitely high on our clients' list. Kim?
Yeah, and I'll just second that. We still spend a lot of time with property casualty insurance and making sure we do detailed audits for our clients on that, which as our clients tend to own many homes, can be very important to coordinate, but also an increased interest in cyber security, not only for the clients themselves, but also for the vendors that are being recommended to use for those clients, is doing a more detailed audit for each of those vendors to make sure that they are in compliance with what we would be comfortable with our clients using their services. And not surprisingly, travel insurance has also become an increased form of risk management over the past few years that we've had a lot of requests about.
Good thoughts, Kim and Domingo. Thank you. Let's turn and drill down just a bit on asset management. A family's shared assets will be a starting point. Interests in closely held businesses, assets of related trusts, co-investment opportunities. The extent to which these may be managed collectively will need to take into account a host of issues listed on this page, the outcome of which will have implication for how their asset management activities will be structured, which assets may be pooled to achieve economies of scale and access unique investment opportunities. The staffing needs of family offices often evolve in conjunction with the family's needs and the services provided. Like any other professional services organization, a family office will need to have a human resources policy. They'll need to think about how they'll compensate valued staff members, looking at benchmarking data, and addressing issues such as whether family members may be unemployed and under what circumstances. They'll have to think about whether or not they'll provide co-investment opportunities to key employees. They'll need to have a contingency and a succession plan. The contingency part of that, of course, has become all the more critical during this process as we've navigated the pandemic. Part of that will also be a remote working policy. They'll need to have standards and even a policy for how the services of the staff members will be measured against expectations on the part of family members. I mentioned the importance of transparency in the decision-making process. The form of that will depend upon the nature of the issue and the family's position regarding the formality of its decision-making. And in this process, I find the metaphor of a table helpful. A generation or two ago, these kinds of decisions were made usually by dad sitting in the study, who would emerge and then announce to the family the kind of decision that he'd made, and everyone fell in line. But I've also learned that in many cases, the mother was very closely involved in that, sitting at the kitchen table, if you will, trying to help build consensus around these kinds of issues. Well, as family issues become more complex and indeed more risk-oriented in terms of whether or not family members will buy in, family members move across this series of tables, and increasingly they find that more formal structures are useful to ensure not only participation, but proper observation with respect to how the family deliberates and how they reach consensus around these issues. And of course, by the time family offices are established, families are usually sitting around a conference table or sometimes even in the boardroom, working with governance structures that are designed to facilitate full participation, transparency, and good decision-making. Kim, let's turn to you to help us understand a little bit more about the distinction between single-family and multifamily offices.
Sure, Hugh. Thank you. So most of the time, when you just hear someone referring to a family office, as you've indicated, they really are referring to a single-family office. That is a structure that's designed for one family and will qualify under the SEC family office exception from 2011 that Domingo might be talking more about a little later. But just as because this is a primer, to qualify for the rule, the single family office needs to provide investment advice only to family clients, be wholly owned by the family, and exclusively controlled by the family members or their entities, and also not hold itself out to the public as an investment advisor. So when we're talking about family clients, it's really the bloodline and spouses. And the SEC has explicitly indicated that the family office rule does not extend to family offices that are serving multiple families. It's only available to single families. So families that can afford to hire best-in-class professionals in-house and create a fully functioning single-family office that includes many of the services, Hugh, that you covered earlier, concierge services, investment services, wealth planning services. For those families that have significant assets to justify that, that can be a really good option for them. But many other families cannot justify those expenses, or the dynamics of the family might not lend themselves so well to the family working together on that. And for those families, there is the option of the multifamily office that you had mentioned earlier, which does serve the needs of more than one family. It might be an organization that sprung out of a single family office that decided to let in other families in order to spread out their costs and take advantage of the economies of scale that can create for them, or just that they've done such a good job for their family, they want to share it with their friends. But really, with a multifamily office, multiple families are combining their resources for efficiency. And so if it isn't springing out of a single family office, it may just be an independent RIA or wealth management firm that has sprung up like ours did to cater to the needs of multiple families. And that can significantly reduce the costs, obviously, for an individual family rather than having their own single family office. Generally, this will be structured as an RIA, potentially a trust company, or possibly even a law firm in some states. And I think we really think of this sometimes in terms of the breakdown of what the size of the family is. If a family has $1 billion, it might make sense for them to be creating a fully functioning single family office. If they have something less than that in the ultra high net worth space, $30 million, David, as you said earlier, there's opportunities to find multifamily offices that might be able to help them with all or some of those services. Moving on to the next slide then, how are this is a bit of a pivot, but for these single family offices, what are some ways for them to be structured? And many of you may have heard about profits interest structure for a single family office. So what does that mean? Well, normally a family office entity would pay tax on all of its earning, and its investment management fees would not be deductible. But if the family office entity is conducting an active trade or business that has a profits interest structure, meaning that compensation is incentives based and taking real risks that the costs of running the enterprise could exceed the returns of what's produced by the enterprise, then if it's structured carefully, the family may be able to deduct the ordinary and necessary expenses that are incurred in carrying on the trade or business of the family office under Code Section 162, so an above-the-line deduction. And that's what people are talking about. And this comes from the old Higgins case, which required an active trade or business in order to deduct expenses above the line from gross income. So while active trade or business is not clearly defined, generally it is going to need to be a regular and continuous activity with a profit motive. And significant entrepreneurial risk is the key. And Domingo may talk a little later about the proposed regs under Section 707A2A from 2015 that relate a little more to some of the potential restrictions there. But just again, this is a primer. 3 important cases for all of you to know about. There's the Higgins case from 1941 that I mentioned earlier. That's the one that requires there to be an active trade or business in order to deduct the expenses. Then there's the Lender case from 2017 that many of you probably heard about. This case supported that when the facts and circumstances align properly, that it is an active trade or business, then expenses can be deducted using the profits interest structure. But I will also mention the third case that all of you should study, which is the Hellman case from 2018, that really concluded that when an entity managing the investment overlaps too much with the owner of the entities, and the facts and circumstances likely will not support the claim that there's an active trade or business being conducted. So this is an area that is for those of you who are working with very sophisticated counsel, like Domingo and his firm and others that we work with. And it's also very important for your clients to always run the numbers. Are the costs and expenses of setting this structure up and operating it going to be justified by whatever the cost savings in deductions may be? Domingo, what are your thoughts in setting these up as far as the appropriate clients that might need them?
Yeah, Kim, you did a great job giving the primer on this. This is an area of intense activity. As we know, the 2017 Acts removed the deductibility of all professional fees for individuals and trusts. So this became a study of a concern for the large family, ultra high net worth situation that would have basically 6 to 7 figures lost deductions between this structure and not. So we've structured these types of planning engagements into first stage as a feasibility study, which, as you said, you need to run the numbers, you need to apply the case law, you need to analyze the current client situation, and then getting in a multidisciplinary way all the advisors in the same room, right? We're reporting on investment advisors. We need to work with the accountants who are going to be reporting this, and then I need a legal structure that's going to justify or fail to justify the trade or business activity. So this is not an undertaking for the non-rigorous client in terms of putting something together that you would just leave on a shelf. This is an active engagement that will continue for every year that the structure is going to be applied to the circumstance. And profit interest is one of those areas that under the 707 regs, as you put out there, the service has had that out. And it's floating out there with some concern that what is key entrepreneurial risk. And the service could crack down on that in a heartbeat. And we know we learned a lot from the venture capital funds, private equity, and hedge funds. So for the people who are familiar with that, this structure can feel very comfortable. For somebody who's not familiar with partnership accounting, this can feel very foreign.
So David, back to you. I think we're ready to go to the next section.
Yeah, before we do, I just want to make a very quick comment. And great job. I think one of the things that has fascinated me, though, is how so many organizations call themselves a family office or a multifamily office, right? Somebody who sells insurance to high-end groups calls themselves a family office. And And I love the way you so carefully define this, because I think that term is confused in the marketplace, and people, organizations for marketing purposes are calling themselves a family office or multifamily office, and they're really not. And so I think this is a great fine point definition here. Great job.
Thank you.
So I think the transition now is to the private trust company, which, Kim, I think you're going to kick that off for us, right?
Yes, I will. I'll help try to quickly give a primer on private trust companies as well. And I think just a word in preface, and this is, playing off of what Domingo was saying, and David, your input as well. If we think about single family offices for clients generally who have a floor of somewhere between 100 million or 500 million at the very minimum, then we should think about private trust companies for clients who tend to be even wealthier than that. So to begin exploring a private trust company for a client who has less than $500 million of trust assets, again, more often $1 billion of trust assets. There's a lot of complication and a lot of work in setting up a private trust company. So, some practitioners and accountants out there may disagree with me. I certainly know that clients are being pitched to set up private trust companies with less than that, based on their specific circumstances. So that could be appropriate. But I did a little piece for wealthmanagement.com, our wonderful provider of this program for today, many years ago, that was about, private trust companies don't believe the hype, because there's a lot of discussion about doing private trust companies, that doesn't mean that it's right for every client. So, you can see the details on this slide, what is a private trust company, and it's pretty self-explanatory based on the bullets that are up there. But in the interest of time, I will just say, the bottom line is that a private trust company is a special entity that is set up by a family that has trust powers in order to act in the state where they set it up as the trustee for all of the family's family trusts, or most of family's family trusts. So, perhaps for a family that's naming the family office executive to be the trustee of all their family trusts, that executive may want to think about opening a private trust company so that it isn't the individual being named, but it is the trust company itself that is being named.
Yes, if I could add a little bit to that, if you don't mind, Kim, we see these a lot at Bridgeford. It's a very, very powerful planning tool for the right family that brings so much control, particularly under modern trust law with directed trusts and using purpose trusts. And we love them. And it's become a big, big planning tool also for international families as well. So we serve and provide those sort of services for families around the world. And in the right circumstances, it provides a whole myriad of advantages and benefits in conjunction with a family office structure.
It can, and we're going to get to those. There's some slides on the benefits. But first, let's just, quick pause on the history of private trust companies. Private trust companies are not new. I actually had a project very early in my career in the 1990s where I had to do a not quite 50-state survey to help a family that was interested in setting up their own private trust company. And it was not a word at the time, that it wasn't something that really existed. So we were looking really at primarily at the public trust company statutes of these different states to see what might be the lowest capital requirements, the least regulation, and the best fit for the family. South Dakota did enact what they describe as their first private trust company statute back in 1995. But really, a lot of other states have joined the bandwagon, and this has become even more common following some IRS guidance from several years ago. And in 2005, the IRS had said they weren't going to issue PLRs on private trust companies anymore. But then in July 2008, they issued notice 2008. 2008-63, which was the proposed revenue ruling that provided a lot of comfort for setting up the private trust companies. And also there's been continuing favorable legislation developing in multiple states. What are some of the reasons for using a private trust company? You can avoid the investment advisor registration with the SEC. There can be increased family privacy compared to working with a commercial trust company. You can create the system to have family-aligned interests between the beneficiaries and the trustees. It can provide more control of investments. It can provide better coordination of distributions across trusts. If the family trust company is the trustee for all of the family trusts and really familiar with looking at what's happening with all of them as far as distributions go, which trusts to prioritize, which a corporate trustee who's only working with one trust and doesn't see across the entire family might have a more difficult time doing. There's also the potential protection of personal liability. Now, this is untested as far as case law, but the investment decisions being made by the board of directors would be subject to the business judgment rule rather than the fiduciary standards of the trustees. And there can also be some corporate cover for the family members who are serving on committees or working for the trust company in different roles. It can also minimize federal and state income taxes, depending on the jurisdiction that the private trust company is moved to, as opposed to working with individual family trustees in the state of origin for the family. And the fees can be designed to essentially be limited to the operating costs of the private trust company. So these are all compelling reasons, as David referenced, that there can be some compelling reasons for a family to want one. There's more, that they can manage unique assets, operating businesses, for example, and unusual investment strategies more easily than perhaps another trustee. You can create a long-term governance and succession plan for the trustees and investment management, which could be more difficult to do with individuals. You can streamline the administration. There's efficiencies in management. Just skipping ahead, it can be easier to bifurcate the decision makers for different functions. The discretionary distributions need to go through the discretionary distribution committee, but that could be a different group than those who are making the investment decisions. And it really does, because it's a family enterprise, allow all of the parties involved to be focusing very single-mindedly just on the goals and needs of the particular family. And because these are family run entities, there's less likely to be a need that they have to go seek court approval or instructions. They're in a better position to work out with the family what the goals are to resolve questions that may come up along the way. Now, as far as once a family has decided they are interested in setting up a private trust company, they do need to determine where they want to set it up. And there's a lot of choices for jurisdictions with states that have either specific enabling statutes that refer to private trust companies or enabling statutes that are similar, that would allow for reduced regulation or perhaps lower capital requirements for certain types of trust companies. And many jurisdictions allow for regulated or licensed private trust companies where they'll be subject to audit by the state regulators. But many states also permit for unregulated or unlicensed private trust companies. And these do offer similar advantages depending on the level of state involvement that the family is comfortable with and oversight that they want. Here's a list of the states that we're aware of that currently have these provisions. If your state has recently enacted one and I don't know about it, please send me an email. Looking at the preferred jurisdictions, personally, in my experience, I've mostly seen families who are setting these up. Here in the Midwest, they do look to South Dakota, perhaps Wyoming or Tennessee as the states that they're most interested as the popular jurisdictions. But Domingo, Hugh, and then David, I'm interested in what you see as some of the preferred jurisdictions in your practices.
Go ahead, Domingo.
Actually, I thought, David, she said you to talk about the preferred jurisdiction.
Well, I was David last, actually. Before we switch over to David's slides, I know he has opinions and is coming, but Domingo and he say a word on the prior slide. What do you see as the most preferred jurisdictions for our audience to know your views?
So I know that people talk about that if you've seen one family office, then you've seen one family office. And nothing could be truer in my practice, because I have clients with, you would think the scale, they would want everything to be regulated. And of course, since they want it so bespoke, that we prefer unregulated. So when you look at these jurisdictions and you focus on, do you want to be regulated or do you not want to be regulated, and the disclosures that are attendant there with the chief officers of the organizations. As we touched on privacy, privacy is one of the biggest things that if you go to a regulated jurisdiction, are you ready to disclose family member or third-party executive, your total income and financial net worth? If you're not ready to do that, as politicians are doing regularly, then you're not really ready to go into a regulated trust company environment. That might push you already into an unregulated, and then when you look at these choices, people will have certain thoughts about each of these additional jurisdictions, whether one is Nevada, New Hampshire, or Wyoming. So I found it interesting how individual clients will choose how to make their decisions on these, but I can tell you I work with all of the listed jurisdictions. I have no favorite. I'm agnostic. I try to make it fit for that client's situation, and they tell me from the criteria that they're looking at where they're going to fit in. David?
Brad, just if I may add one brief observation about staffing, that there's a staffing issue associated with any of these jurisdictions. To the extent that you need to have employees work and live in those jurisdictions, there'll be issues about whether or not they want to live there. Now, some people would say, given that I decided to retire in Minnesota, that that's not necessarily a real attractive jurisdiction at this time of the year. But I think one could say raise similar issues about some of the other jurisdictions. David, let's come back to you.
Yeah, no, sorry. Very, very briefly, and I do need to mention something, that secret word that I told the audience about, you need to know that now. So the secret word is wealth for you getting CE credits. So I'll repeat it, it's wealth. And very briefly, in terms of the conversation around private trust companies, it really, the devil in our mind is kind of in the details. I mean, certainly I've already indicated I'm an owner in a South Dakota trust company, but there are top tier trust jurisdictions across the board that have been generally considered top tier. Trust in the States magazine does it every other year. And we put together a chart. I'm not going to go through it line by line, but the goal here is it's an objective measure. In addition to privacy concerns Domingo talked about, there's also asset protection concerns and different legislative and legal nuances in each of the top tier trust jurisdictions that really need to be looked at. So regulated versus unregulated, of course, is a bit of a debate in my mind. And Domingo kind of mentioned it. If privacy is the primary driver, that's fine. But being unregulated brings some problems as well, which is who's overseeing the operations of trust companies. If a billionaire family wants a private trust company, who's making sure it's being run correctly? Well, that's what regulation does. And so I think that the argument kind of goes both ways. This chart, though, is offered as a comparative data point as folks consider private trust companies and think through where they want to be. So those are my comments there. Once again, I will repeat, the word is wealth for those of you who would like your credit.
Yeah, and I'll just keep going as far as, the advantages and disadvantages of regulated versus unregulated. As David said, it really will vary family to family as to what level they're comfortable with. But even a state that is unregulated, for example, in Florida, my understanding is that they say they're unregulated and there's no audits, but there still is, significant oversight and disclosures that do need to be made that can give the family some comfort if that's something that they're interested in. This is a slide we've included thanks to Bobby Bierhals and the team at McDermott, because the last time I presented on private trust companies was with her, and I really liked this slide. But we won't spend time going through the slide. You can do that in your own time later. And then finally, we do want to end with some of the disadvantages of the private trust companies. we've alluded to throughout, it's expensive it can be, depending on who you're working with and what type you're setting up. There can be initial setup costs that can be expensive. There can be information requests or disclosure that ends up disclosing confidential information to the regulators more than the family might have wanted. Independent parties do need to be involved in decisions, and there does need to be a connection to the state. Certainly, Texas private trust companies tend to be very popular with families that are already in Texas. Intra-family privacy concerns can emerge if you've got some family members on the distribution committee or investment committee for other family members' trusts. And there may be more sharing, intra-family sharing than the beneficiaries might be comfortable with. And then, like any business, there does need to be a succession plan. All right, let's move on, Domingo, to your section about regulatory concerns.
Okay, as I see where we are at 40 minutes past the hour, I'm going to make sure we move through this a little bit swiftly, but highlight key points that I know have hit the family offices that I directly work with. So under Dodd-Frank, I just want to highlight on the second column here that the 1940 Act previously had a private advisor exception, and it was for an advisor who had 15 or less clients, and if you did, your family investment vehicle could be exempt without registration. That was under the 40 Act. In 2010, we got Dodd-Frank, which removed Section 203(b)(3), and effective July 21st, 2011, there was a new stated goal that the SEC be allowed to regulate both family offices and hedge funds. So what the SEC did is said, we will define now family offices. In this column you see over here, which is the definition that Hugh mentioned earlier, the SEC has described family offices as entities established by wealthy families to manage their wealth and provide other services to family members, such as tax and estate planning services. That definition has kind of been the hallmark now that they said, here are all the rules, and here's how you have to be related so that you have an exemption under the family office statute, or this family office exemption now under Dodd-Frank. The interesting thing, and this is why I'm highlighting this, is that there were two parts of this point under the 2010 law, that there was a goal established by the SEC to regulate advisors to hedge funds and other privately offered investment vehicles. And what the SEC did is they defined then their new rule for defining a family office, and then they had all the degrees of sanguinity, which means how closely you are related and whether you're related by marriage. And if you were related by marriage and then got divorced, could you still be in the family office? All of those things got defined, and that was very good. That provided a lot of clarity. But what they didn't do is define hedge funds. They left that topic to be attacked in the future, and that was a very difficult topic, and it took more time. Why do I mention that? Well, in the meantime, we've got regulation best interest. For those who are looking at this, this used to be known as a fiduciary rule for investment advisors. The SEC came short of calling it a fiduciary rule because the investment advisor industry and others did not want to be called fiduciaries. They wanted to say that we would comply with the best interest of a client, but they didn't want it to be equalized in the eyes of the law that they are an actual fiduciary. And there are certain reasons when we get into the legal nuances about regulation BI and what it would be when you see how it applied. Quick story, this applies to our clients because clients custody their money with investment advisors and banks. And when you do that, sometimes you're a retail customer, sometimes you're an institutional customer. Institutional customers do not have to comply with regulation BI. Retail customers do. Prior to the issuance of a no-action letter last December, the SEC had to clarify that even if Warren Buffett walked into any retailer, he as an individual would be a retail customer, and he would not qualify as a sophisticated investor and would have been subject to the more onerous rules for providing retail customers with advice. Accordingly, certain institutions, since they didn't have the comfort until the SEC gave the guidance, were ready to move out clients such as mine, even if they had very large 9- and 10-figure deposits, because they thought that they were potentially a retail customer until the SEC said they weren't. You weren't sure where they would stand. So now we understand that the family offices will fall under being exempt from Regulation BI because they're institutional clients. So going back now to the standard of what did the SEC do under Dodd-Frank? They didn't define hedge fund businesses, and look at what ends up happening. A family office in the news, and I call it a family office in air quotes because it's not really a family office. We have a convicted felon here of trading activity, barred from trading from other people's money, with a very large account, trading on his own, who ends up in doing a total return swap, and everybody calls this a family office. So much so that AOC introduces legislation last year to regulate, completely undoing the Frank Dodd exemption for family offices, saying that we need to regulate all family office because of this potential collapse. Thankfully, that legislation hasn't moved forward, but making sure that the fallout from this, the further blurring of the lines that Hugh is taking great care to say, well, this is how we want to define family office. David noting that in the marketplace, it's really murky. What is a family office? And here, the Wall Street Journal calling this a family office that was just doing advanced trading activity. There was no estate planning services. This wasn't even trading for the preservation of wealth, as we saw the SEC quoting. This was for gains, and it was violative of the laws as they're going to be defined now. And when it was done by Archegos, then we know that the impact of this regulation could be a swinging of the pendulum back and forth. And we see that industries and family offices need to be cognizant of their own rights, because you're going to have the Corporate Transparency Act and the the Financial Crimes Enforcement Network, FinCEN, under the SEC is now asking for further compliance in the Corporate Transparency Act. And suffice to say that if you read through this regulatory body, the Private Investor Coalition solicited the Family Office Network, the Family Office Exchange, its network, as well as family offices, to provide written comments to FinCEN to say that there should be an exemption for compliance by family offices when they already comply with all the other regulatory networks that's out there. The idea that, as they really proposed here in their Regulation 1, that this would be a minor compliance issue that would not take more than 3 to 4 hours to fulfill is preposterous. And the comments have been provided that to do this for all the entities that are attendant with family offices will be an onerous undertaking. And the question is, will the burden of this regulation be worth the benefit, knowing that, one, in 2010 we had a swinging of the pendulum and we were broadening things out to exempt family offices. Two, under Reg BI, we saw the SEC further define family offices to be exempt from regulation best interest. But then you have Archegos blow up, and now we have the Corporate Transparency Act that's been in place. Where will we come out on this? A bigger regulatory body or not? We don't know, but it goes to the question David Warren was pointing out there. As we say, private trust companies, regulated or unregulated. Do we want more government or less government? And with that, I will turn this microphone back over to talk about the investment issues, which is, of course, why the 1940 Act was in place to regulate investment issues.
Let's talk for a moment about one of the most common practices in family office, which is investing together, pooling assets of family members or similarly situated trusts to meet often investment minimums for unique investment opportunities. That might be direct investing or co-investment opportunities. It could be private equity or venture capital or even hedge funds. It'll also require the creation of a vehicle, many times a limited liability company, sometimes a family limited partnership, to facilitate the combination of those assets for collective investment purposes. Pooling will require some due diligence on the ability and the willingness of family members or fiduciaries to contribute assets, and it'll present a number of economies of scale and diversification benefits and potential transfer tax benefits associated with estate planning strategies where these minority interests in the vehicles may be transferred to next generation family members. But it will impose some not insignificant accounting and tax compliance costs, which certainly merit due diligence and understanding. The ability to access unique unregistered investment opportunities, private offerings, will require meeting financial criteria under SEC Regulation D those associated with the definitions of an accredited investor and a qualified purchaser. These are fairly bright line definitions for individuals, as we see on this slide, and for business entities on this slide, and for trusts, as we see on this slide. I thank Kim for this very excellent visualization of the important if-then analysis that needs to be applied to ensure that these definitions are met with respect to any particular investor in the family office. So the SEC has drawn some pretty bright lines around these definitions, but the IRS is increasingly concerned about wealthy taxpayers who like to color outside the lines, at least in their judgment. Domingo, can we come back to you to educate us about the IRS Wealth Squad?
Pleased to do that. So in the past 2 years, we've had the commissioner come to Congress and testify about what's going on at the IRS and the collection of revenue and the enforcement of our tax laws. And he reported that they've lost or retired 17,000 enforcement employees. Now, this was even before COVID, so you've got to think that these numbers have only been going up. Now, with the decrease in headcount, you might think that there might be less enforcement going on because you have less bodies to do it. But this is where the beauty of computers and AI technology has come into place, and that has allowed them to update their systems so that they can continue doing exams. 35% of the exams that we're saying here of agents handled by complex have dropped because of this idea that we can use more computers to make sure what we're looking for, what the IRS is looking for in terms of their enforcement. But what they want to do, and what the commissioner has said, is focus on high-income, high-wealth taxpayers. And why? Because he says that there's $1 trillion in taxes that's going uncollected annually. That $1 trillion will focus on filling a budget deficit. And when we look at the areas that they're focused on, high-income, pass-through, multinational taxpayers, pension plans, private foundations, we then see that they're slowly moving this needle. Examinations closing in process in 2015, they're saying these numbers look down. But if you actually compare the exam rate, it's 23% exam rate in 2010 if you have more than $10 million in income. That number is expected to go up significantly, so that what we're anticipating, and you see here for 2011 to 2018, estimates are that the audit rate fell 74% for taxpayers with $1 million or more. They want to undo that trend. Our experience has been for returns that are not electronically filed, which will be estate and gift tax returns, generation skipping tax returns, all are not filed electronically. They are pulling those because they're being manually filed, and we're experiencing an 80+% audit rate on those filings that we do. So we're managing towards that because, as we see, the IRS has published what they're doing with respect to AI. Income tax return information is very quick. It's all third-party reporting. That's why they need the Corporate Transparency Act. A lot of that does make sense to streamline this process. They're not yet there with estate and gift tax, but we can anticipate, at least for the foreseeable future and probably funding a lot of people's retirements, you will be audited for high net worth situations, and they're targeting high net worth situations with a wealth squad that is both the large business group, one division, and the small business group. Both of those are being set so that they will seek further enforcement. It is part of President Biden's budget proposal. He hasn't come up with a new budget proposal yet, and he was looking for $13 billion to the IRS, which would be a 10% increase over the prior year. We'll see what comes up for this year. You can expect enforcement to come in the future. The Wealth Squad, as it was announced, was basically for the $10 million and up in large business. They also have a small business group that they're focusing on, and we expect that there will be increased audit activity, as I have said, because we have seen it happening in our client-based filings. What has changed since 2009, a lot of this is, you can read this material, but it's really the turnaround of the technology and Commissioner Reddick coming in saying, we're going to modernize the IRS so that we can be targeted and get more money collected. And their new enforcement of this has been laid out since last year from May 2020 to what they're now doing into April 2021 with Biden having requested this significant increase. We will see what budget proposal comes in for this next period, and then we will see where we are going to be with a bigger enforcement division from the IRS. I suggest then for all of our client situations that we start thinking about how this impacts them. A lot of clients do not regularly handle audit situations, and even some of them call it would be a catastrophe. I have a bunch of clients who insist on filing on time April 14th, which is Hugh just laid out. A lot of private investments are done. There are no private investments that are ready to file on April 14th. So if a client wants to have access to private investments, chances are they're not going to want to file on time. It is a good advisor who can talk to a client and tie these types of things together, because when they get their first audit, when they've also just made their first private investment, and it's because they filed on extension, you can damn well be sure that they're going to be upset about just the fact that they're being audited with everybody around the table. So I suggest that we think about how this actually is handled, as Hugh aptly pointed out, at the kitchen table, or even in the study, because it's at that point that you may be either viewed very favorably because you brought something to the family, or be viewed very unfavorably because they're being audited and they're talking about it at the kitchen table and in unflattering ways because Hugh, Domingo, David, and Kim brought these strategies and we filed late. These audit situations where we now know about this is all public information about what the IRS is doing. For your clients not to go in with eyes wide open about an audit or what happens when you're in a private investment and that you will be filing on extension is really at this day and age unacceptable. Okay, enough about that. Let's go to single family office and ultra high net worth trends.
Yeah, and just a quick moment on that. We've seen, of course, a lot of activity since the Just Kidding bill was a threat last year, and that's continued into this year. Of course, we've seen a lot of trends with family meetings going virtual, and that some version of that might be here to stay, although getting the whole family together at a nice vacation spot where they can be in person is still preferable for many families. The involvement that they've been able to get from more family members by being virtual has actually been very beneficial. And then finally, I'll just note that personally, of course, in my role as working at a multifamily office, we have noticed a lot of single family offices that either are no longer trying to be fully functioning single family offices, so they really are looking to their outside advisors or to a multifamily office to help provide investment, wealth planning, or reporting services or other services to their family members, or even single family offices that get to the second or third generation where siblings and cousins are acting together, who realize that it might be more efficient and more pleasurable and emotionally beneficial to them to be joining single family offices. So those are a couple of trends, but let's get to a few questions before we have to shut down.
Certainly, we have a few minutes left, and we have some great questions. There's one in particular, maybe targeted a little bit towards you, Domingo, which you had mentioned FinCEN and CTA a little bit. And the question is from Amy. The FinCEN BSA requirements that had to be in place for trust companies by the end of 2021 applies to private trust companies. And I think you commented on that a bit, but could you not only answer that specific question, but maybe talk about the work you've done in that space as well? Because that's a hot topic right now for really all of us in the industry.
Sure. So if it's related to the Corporate Transparency Act, the way it's coming out here is it would apply to everybody. And so FinCEN was not giving us any exemptions. And so if you pull up the comments to the regulation, the request for an exemption from the filing is what is being done there. So now that's on the Corporate Transparency Act. I see Amy's question is actually in place for trust companies by the end of March. That is referring to regulation that's not part of the Corporate Transparency Act. And my understanding is that, yes, that would apply then to those entities, especially if you had you were doing something related to a federal charter. Now, this gets into the areas of federal state law. When we were talking about state regulated or unregulated, it was all state law. And Kim put up some specific statutes. I know there's a question in here about where does Florida stand in the private trust company world. Well, Florida doesn't have a separate private trust company legislation, so hence it wasn't on the list of the ones that we were discussing. So if you don't have a private, like Illinois per se, doesn't have a private trust company statute, there are ways you can adopt a statute to use that, then you're talking about state versus federal. So FinCEN, federal regulation applies to everybody. State regulated versus unregulated deals with the state of jurisdiction that I'm in. And so certain states are unregulated, and then you don't even have to comply with the regulated aspects. And some states have both. So for instance, Wyoming, which was cited in one of these, and I know we're going back to the slides on these where you're talking about the jurisdictions, certain of them have, as Hugh pointed out, personnel requirements. Well, that's if you're regulated. If you're unregulated, guess what? You don't have a personnel requirement. Now, you still may have to do annual meetings and the like, but you don't have to have physical presence in a particular state, depending on which state you're picking and what you're looking at. So I would say here the safe bet is going to be double checking for the FinCEN, whether or not it applies for the regulation versus unregulation. We could double check that. I don't have that right here in front of me, but I would assume that it would apply because it's a federal regulation that's applying to everybody.
Great. Well, with that, we are out of time. Domingo, thank you for closing us out. The three of you were fantastic. I think very, very knowledgeable and very useful information was conveyed today. I'm going to repeat the word, which is wealth, an important word for everybody to have to obtain your CE credit. And I certainly want to invite you to check out upcoming forums and a widget that should be on your screen there. Bridgeford Trust Company was thrilled to be a part of this, again, because of our passion around family offices, multifamily offices, and it's a very timely and important presentation. So thank you all for your preparation and great presentations today.
Thanks, David.
Thanks, David.
Thank you. Thanks, everyone, for your attention. We're all here for questions if you have any. Just reach out.